The Bank of Canada recently raised its benchmark interest rate by half a percentage point to 1%. In today's video, we're going to discuss exactly what this interest rate hike means for Canadians with variable rate mortgages and homebuyers looking to purchase. But first, let's roll the intro. Hey everyone, Josh here, and before we start, I just want to remind you to hit that subscribe button and turn on the post notifications so I can continue to make more content like this in the future. So as you probably heard, the Bank of Canada just increased its interest rate. It's the second time in a very short time period that the bank has once again decided to push its interest rate higher. It was also the bank's first back-to-back rate hike since 2017, as well as its biggest single hike since the year 2000. The most recent interest rate increases were done to help defend Canada against rising inflation and housing prices. Canada's inflation hit 5.7% just last month, and the price of everything from housing to food to gasoline has been going up at its fastest pace in decades. When the COVID-19 pandemic had begun in March 2020, the Bank of Canada had lowered its rate to just barely above zero. While originally the decision to lower interest rates helped the economy weather the unprecedented uncertainty of COVID-19, in recent months, inflation has become a major concern for our nation and has come back at higher levels than we've ever seen in the past decades. According to many experts, including myself, Canada's latest mortgage rate hike should not impact Canadians' ability or desire to refinance or renew their mortgages. It also likely won't have any major impact on the market right away or in the near future. Right now, we are in a time of record low interest rates even with the most recent hikes. Variable rates are still an attractive option because the key interest rate would have to go up several more times to match the current fixed mortgage rates. You also have to consider that with a fixed rate mortgage, you are locked into your mortgage contract for a specific term, which does of course have its benefits. However, in all consideration, when comparing to the current variable rates, we must consider the potential cost and penalty for breaking a fixed rate mortgage contract for whatever the case may be. If you were to break your contract on your fixed rate mortgage before the end of the term, this penalty will likely end up costing you more than any near future interest rate increase added to the variable rate mortgages. For a long time, Canadians have been lucky to experience low interest rates, which means the current and expected rises will lead many mortgage holders into new territory. The banks, however, are not overly concerned as Canadians on variable rate mortgages should still be able to afford the rate hike because they would have needed to pass a stress test before getting approved for their mortgage. I guess we'll have to wait and see how the markets react. However, in the near future, these rate increases probably won't be making much of a difference. Hopefully you enjoyed this video. If you've made it this far, I want you to let me know below in the comments how you think the current interest rate hikes will affect the Canadian real estate market. Will prices continue to go up like they've been doing for the last several years? Or do you think this will help balance out the market a little more? Drop a comment below and let me know. Don't forget to like, comment, subscribe, and turn on the bell notifications for more content like this, and I'll catch you next time.